Great. Well, hello and welcome to this webinar on the transfer pricing environment in Africa. Just so that you know that you're in the right place, this is primarily for tax and transfer pricing professionals in the rest of the world. And it's aiming to really pick the brains of our experts here and explain what is different about African TP and the environment there, and the fact that you can't possibly make assumptions that it is similar to the rest of the world. So in terms of agenda, what we're going to go over is firstly setting the scene in terms of the TP landscape in Africa. We'll go through some misconceptions versus reality in terms of the transfer pricing environment. We'll look at recent case law and policy announcements and what to watch, and then practical steps to protect positions and Q&A at the end. Just some housekeeping points. We will share the recording and the slides after the event, so you don't need to worry about that. And if you do have questions or anything that you'd like to put to our experts here, then please do use the chat function and we'll do our best to get to those questions. So thank you very much, Cabrini and Rajnish, for joining. Maybe you can just say a few words about your background.
Sure. Thanks for having us, Paul. We're quite excited to be here to talk about Africa. Maybe just a little background on our firm. We're Regan van Rooy. We're a boutique international tax and transfer pricing firm specializing in Africa. So we deal with all type of tax matters across Africa, and obviously transfer pricing being pretty critical. And we're based mainly in Africa. Obviously, I'm actually Irish, so we also have European offices and feed into the Irish market and wider markets. My background is I started with as a lawyer, and I was with Deloitte in London, and then I was seconded over to Deloitte in South Africa, where I ended up staying for many years to build out the African transfer pricing practice of Deloitte, which was a big journey, a lot of fun. I was the controversy leader there across Africa, and basically during COVID, I decided to come back towards Europe, but I could not stay out of working in Africa just because it's such an interesting place to work. The tax authorities are difficult, the environment is interesting, and the people are dynamic. So that's why I stuck with Regan van Rooy and kept a focus on everything happening in Africa. Raj, over to you.
Thanks for having us, Paul. My name is Rajnish. I'm a transfer pricing director with Regan van Rooy. Previously, I've worked 17 years in Big Four with EY, Deloitte, and KPMG across jurisdictions from London to Singapore and on various African. Currently, I am located in Dublin and work on many of the African projects along with Cabrini in Regan van Rooy. That's all in brief about me. Thank you, Paul.
Fantastic, thank you. And I think you've already explained, Cabrini, in your introduction about the firm. Is there anything that you wanted to add that people should know about?
I think in terms of what's different about us in Africa, we do compete with the Big Four, but we offer a one-stop shop. So we're centralized. We don't outsource our work to Kenya or Tanzania. We actually centralize the African support, which is quite unique. And yeah, I think we often have a tagline of we're quicker and cheaper and better in the market, but that's our unofficial tagline. But basically, we deal with tax headaches, and we have quite a senior team in terms of we've taken on a large number of ex Big Four partners from Africa to enable us to do that through one central point. But that's enough about us. We have more interesting things to talk about, I'm sure.
Cool. Thank you. So for those that don't know me, my name is Paul Sutton. I'm a corporate lawyer by background, as we all are at LCN. And we specialize in taking a global perspective in helping corporates to design the legal aspects of intercompany transaction. And that means designing intercompany agreements, keeping them updated, and often identifying gaps and defects and fixing those gaps. My route to this is that I was a corporate M&A lawyer for around 9 years, based in London, then moved to KPMG's law firm back in 2001, which is how I got exposed to the wonderful world of international tax and transfer pricing, and developed this specialism. So we don't advise on tax or transfer pricing. It's purely the legal aspects and making sure that corporates are well protected from a legal point of view. So let's get into the exciting bits, which is setting the scene. Cabrini, Raj, do you want to kick off?
Absolutely. So, what's happening in Africa right now? So, obviously, transfer pricing has been around for a long time. What's a bit unique about Africa is the fact that, off the back of the base erosion and profit shifting project and all that's happening globally, driven by the OECD, nearly every country in Africa either significantly updated its transfer pricing legislation or took in new transfer pricing legislation for the first time. So that's quite gigantic. So that means, compared to other jurisdictions, the law, certainly in terms of the implementation of the law, is still relatively new. So what have the tax authorities done is that has been a key focus in terms of team building and resource allocation, right? Transfer pricing is considered in Africa as the biggest tax risk and also the biggest pot of money for the tax authorities, which is why there is such a high level of scrutiny on it. Now, like in any place, when you take in new legislation, it's going to take a little while to enforce it. So the initial stage was take in the legislation, take the people in, and now what they're doing is enforcing it through rigorous compliance rules and regulations and penalties. And of course, that's led to a spate of audits and the first kind of big round of case law. Only recently in the last 2 years, we've got actual case law stuff has gone, up the value chain to the Supreme Court, and we're starting to get legal precedent. So quite a lot happening in this space. What's different about it is that we are often dealing with inexperienced tax authorities in transfer pricing. So there's a big drive on building that up, and they are working with the OECD. They work with members of HMRC. They've had training from the Scandinavian tax authorities, no less. So they're and ATAF, the African Tax Administration Forum. So heavy investment, which of course means lots for the taxpayer to think about locally. Paul, we can jump to the next slide, please, and shout if you have any questions. So what's kind of happening there? So obviously everywhere we've had these information sharing, right? So there's a lot of information sharing. So basically information that the taxpayer never had access to is being populated into the various local files, master files, and country by country requirements. And a lot of the African countries have signed up to the Information Sharing Acts, and information is flowing significantly more ready. As well as that, for the first time, and we're really literally being audited on the local files now in the last few years that have been prepared, is there is so much information out there. There is so much information that the tax authority has access through compliance, and then will ask for further as evidential backdrop. So that's a lot of things happening. We also have other legislative changes which are relatively new. So places like the UK will be very familiar with the APA program, the Advanced Pricing Agreements and MAPs, and they can be quite successful for those unique circumstances that it fits. South Africa, amongst other countries such as Tanzania and Kenya, have initiated those programs and invested quite heavily in that. So that's something that we're going to see happening, probably not successfully for a number of years, but in play and in progress. Maybe some of the other, you can flick to the next slide. Maybe just what we think about what do we want to know about Africa that's different from transfer pricing anyplace else, right? The first thing is the thresholds. If you're in the UK, the US, or many European countries, you're going to have pretty high thresholds before you have to get into a local file and master file. In Africa, the thresholds are what I would have to say is tiny. So you would think, well, I don't have a risk or I don't have an exposure. My transactions are a couple of $100,000. You could fall into the compliance threshold very quickly. So many, many more taxpayers are actually caught up by the compliance obligations. That's the first one. The other nuance is probably we don't just have cross-border legislation when it comes to transfer pricing. There's quite a number of countries that have domestic rules. So that means if you've got two entities in one country, you think you don't care about transfer pricing, but of course you do. And another weird anomaly is that they have expanded the legislation in certain jurisdictions to cover non-connected parties, but key suppliers who are based in what's classed as a low tax jurisdiction, which is like a whole new level of what transfer pricing means. So that was a bit of a scary one for certain taxpayers to get their head around. Then we have this thing where we said, right, we have all this new law. Now you have to prepare these files. The first thing is that in most countries, it's a holding requirement. And in many countries in Africa, you have a submission requirement, which means, for example, in South Africa, if you meet certain thresholds, you have to submit it online, right? So that's like a big difference than just having it prepared. And also in the jurisdictions where it's a holding requirement, it generally has to be done when your tax return is prepared. But if it is requested, you will have a very small window to give it. In some countries, it's 7 days. In some countries, the longest term is normally about 30 days. So that means basically a lot more compliance for lower value transactions. You might think from a group perspective, not too concerned about Africa, it's all fine, but you might have these obligations. And of course, if you do not fulfill those obligations, you have problems with your auditors. You can't get stuff signed off, you have delays, and you have audit requests. The other thing is what we call the tax authorities looking for the easy money. And what is that? That's non-compliance penalties. If you're supposed to have a local file and you don't have it when you're supposed to have it, and your transfer pricing might be perfect, you might have no transfer pricing exposure, but you could have a compliance exposure. In some countries, it's pretty routine. It can be something like 16,000 rand a month. In other countries, such as Zambia, it's up to $1.2 million. So that's an easy win for any tax authority. If you don't have a file, of course, they'll look for that. They don't even have to look into your file. They just say, you don't have it, pay up, you're not compliant. So I think that is a trap that a lot of people who are new into investing in Africa or aren't up to date yet with all the legislative change can very easily get caught in. As well as the local file, the kind of the standard compliance, there's also TP declarations and TP returns that have different time zones and different disclosures. So the paperwork is pretty heavy, unfortunately, in Africa. What else have we got? The other big ones are local regulatory restrictions, right? So importantly, let's say Zimbabwe is an example. They have caps on management fees, right? So you cannot, and that will be on a deductibility basis and also reserve bank basis. You cannot get, say, more than 1% of turnover out as a management fee. So you have to actually check, oh, my management fee is this. Well, is it more than 1% of my turnover? It's capped at that. And beyond that, it's not deductible. Same with royalties. We have royalty caps. So we always have to check if we have a global model that works everywhere else. Do we have regulatory restrictions that is stopping us from implementing that model? And what implication will that have? And the other is the banks, right? The hardest thing about operating in Africa, as well as the interesting tax environment, withholding tax being quite a torturous one for businesses in Africa, is can we get the money out of the country, right? So we have reserve bank approvals, central bank approvals. And the new trend is, so first of all, there's caps in certain cases. They tend to be higher than local caps. But what you will have to do is you have to have transfer pricing support to get the money out. So if you've got a related party transaction and you think it's fine, for example, in South Africa, they've taken in a new rule for every SARB application, which is the South African Reserve Bank, you have to have a transfer pricing document ready. And that means even where you don't meet thresholds, if you're trying to get money out of certain African countries, you have to have your transfer pricing right, and you have to have the documentation in place. What else is happening? The other thing, I guess, in Africa is how long the audit period is for transfer pricing. So that is 6 to 10 years often. And if you haven't met your compliance requirement, they can state the prescription hasn't run. So if you haven't ticked your box in terms of your compliance, that 6 to 10 years could be infinite. And the other thing that I think is kind of interesting is that even though the legislation is, relatively new, or in some cases they say it's old, but it's updated, there's retrospective application of that. They're saying, a bit like the OECD guidelines saying, you always have to transact at an arm's length. We've just made it clear that you now need to document that arm's length through a local file, through a benchmark, and so forth. So that can kind of catch people pretty quick. Another thing is the trend. Paul, you look like you had a
Yeah,
question
yeah.
for me.
Just had a question. So you mentioned this. This is a new environment. Notwithstanding the sort of retrospective perspective on that, and that members of the tax administrations might be relatively inexperienced. What's your experience been like so far in actually engaging with tax authorities and inspectors and actually resolving disputes? What kind of dialogue can you expect?
Well, having worked with the HMRC during my time in London, it is a total different experience. You have quite nice, sophisticated chats. The tax authorities in Africa are very difficult. I hope there's none here listening to me, but it's a more complex environment in terms of oftentimes they're coming with the attitude of, you are a bad taxpayer, right? Show me the opposite, as opposed to coming open hands, let's work on this together. There's a little bit of a reputation in Africa, particularly with multinationals, is that they've been shifting profits out of Africa for years, right? That's why the focus of tax authority has been on major economies. So, exports, all commodities, all of that. That's where we have major audit focus. So they generally tend to like to settle, generally don't want to go through the full court process, although that's being pushed, right? Because Africa wants to have a precedent, wants to have a set of rules, it wants to have case law. It doesn't just want to settle with the tax authority, right? But you always have to choose your battle. But I mean, we've just, for example, settled a 3.2 billion exposure with a tax authority and brought that down to 500 million. So they're becoming more sophisticated. They have great influence from learning and capacity. They have just taken on, in many cases, technology solutions. So the use of AI for audits. So very advanced in terms of that. And their focus being particularly on transfer pricing, the resources are there. There's a distinct way to deal with the tax authority. You should always have a local person involved. The relationships are critical, like with any tax authority. You need to make sure you have the right person in the room, preferably somebody who's got a good relationship with the tax authority. But all in all, they're good, but it's complex, and you need to make sure you have your ducks in a row, and know who you're talking to and about what you're talking to.
Cool. And you mentioned about this sort of exchange control, so it's not just the transfer pricing issue, that transfer pricing documentation is part of the documentation needed to actually extract funds. So is that like China? So central bank control or central bank approval is typically required, and you have to produce agreements as part of that package? Or what does it look
Exactly.
like?
It's exactly. So there's Reserve Bank approval. I mean, one of the difficulties with doing business in Africa is, how do I, manage my fund flow? And often people will have hubs in Mauritius or other jurisdictions where it is easier to manage your flow of funds, which is obviously critical for a thriving business. But it's exactly like that in terms of there's a specific process. It's often through the banks themselves, that there's forms and things you have to do. And now that used to be just give a legal agreement and show that, this is just. But in the last, I think it's 18 months now, you have to actually file up a letter that basically says, this is compliant with transfer pricing, this is our thing, we have a local file, we do all the stuff we're supposed to do. And that is because the banks who normally deal with this were under too much pressure. They don't know if it's arm's length. They're not an expert. So they basically will ask for an expert transfer pricing opinion to support that. And, normally you don't want to give them your whole local file. Normally you want to have a letter from an advisor that says, this, the transaction has been approved. They're compliant with the arm's length principle. They don't audit it, but they will want it from an independent. They don't necessarily just rely on you. And they will require sign off from the appropriate person in the entity that says, yeah, they confirm that this is correct. So it's part of the risk management process, and part of some of the complexities of funds flowing in Africa.
Interesting.
Not easy, but I promise it's all worthwhile. There's so much opportunity there. There's so much growth, but you have to know your way around Africa. It is quite different than other jurisdictions. Just quickly on my beautiful map here, which I bet everybody's hoping that they're doing business in these green countries, but this is essentially a risk map. where is the highest level of audit and compliance? So it's obviously, it's your South Africa, it's your Kenya, it's your Nigeria. They've been enforcing transfer pricing for a long time. Places like Ghana, Tanzania, Zambia, Zimbabwe, all of the usual suspects. In the orange, we just leave them orange to be nice, but we've obviously seen a real increase in audit activity and scrutiny of transfer pricing. And then there are other jurisdictions that are still biding their time. But an example of countries where we never thought we'd have transfer pricing legislation is, for example, Mauritius just last summer basically said, now you have to have a local and master file here. Seychelles took in the transfer pricing rules. So, of course, everybody's in a panic because substance is obviously lacking in many of these jurisdictions, and now they're becoming under scrutiny. So, unfortunately, it's going to be more and more audits. While I'm on that point of substance, because that's what's being challenged, one of the key audit trends is to look for structures. Let's say we're paying out for intellectual property, or we have contract revenue or whatever in another jurisdiction, or we're arguing limited risk or whatever. There is an absolute focus on, is the appropriate substance on the other side? So legal substance has no meaning. Do we have economic substance? Can we prove that from a transfer pricing perspective? So as a result of all of this, of course, what we've seen, and we'll have seen this globally, but maybe more recently here, you have businesses who are restructuring and you have businesses who are moving people. So I often say now, if you go to some of the beaches in Mauritius, you will be hobnobbing with the CEOs of major businesses, the CFOs, key strategic players, in terms of, they said, right, we have to build legitimate business substance here. We're actually going to live here. We're actually going to be tax resident here. We're actually going to drive the business from here. So obviously that's quite a major change. Obviously, anytime you have a business restructure, you've got a whole other kettle of transfer pricing things to be looking at. And one thing I wanted to note that happened recently with one of our clients, where IP is not being thought about, intellectual property. Where is my intellectual property really? And there was a client who was selling a major business and had always thought that the IP was sitting safely in jurisdiction A, but as it turns out, because it might have been legally there, it wasn't economically there. It was actually in multiple different locations. On the exit, there's massive capital gain tax. There's like loads of different implications where the IP is not where you think it is. And they had to knock off about 25 million US dollars as part of the price negotiation tool because this hadn't been fully considered and thought about. So, it's in terms of business owners working in here and looking at the value proposition, we know that even in the recent case of Coronation, you got money being knocked off your share price when it comes to a transfer pricing issue in Africa. So it's big money, it's important, and it needs to be gotten right. So it can come in at all. So we say this isn't just something for the tax guys or the finance guys. This is about, kind of serious business things when we're looking at, where am I paying tax and where's my profit actually sitting? And should I be paying 27% versus the 3% I've been paying here? And what does that look like over the last 10 years? So, yep, very interesting landscape. And hopefully that colorful map doesn't scare too many people, but it will give a bit of guidance on where the tax authorities are most aggressive. You can flick on to the next slide, Paul. This is just to show basically nearly every country, and this is not every country in Africa, of course. We largely focus on the English-speaking ones, but we also cover some of the others from a strategic perspective. But basically, if you look here, nearly every country, you have to do a local file. And nearly every country, if you don't, you will have a penalty and an exposure on a compliance side. And most of the countries, you will have a master file. Now, there is thresholds. That doesn't mean, every single one. There is thresholds per jurisdiction. All the thresholds are different. Sometimes it's a transactional threshold based on the value of the transaction. And in other cases, it's based on the revenue of the entity, right? So even if you meet a revenue threshold and your transaction value is $20,000, you can still be caught by that compliance obligation. Or you might have a low entity revenue threshold, but you have a transaction that's $200,000 a year, then you could fall into that gap. So one needs to be quite careful in terms of understanding which jurisdiction are you in to not get caught by these little nuances. So it's quite important to note. People always ask, do we follow the OECD? Can we use the OECD files?
Mm-hmm.
And in general, yes, but with the exceptions, what that means is you have to have a functional analysis, you have to have a selection of method, you have to have a benchmarking study like you will see in the rest of the world. But the nuances come around the transactions. Do I have to submit this file? And do I have to have domestic transactions in there? And do I have any regulatory gaps? So if I've just got a global policy, but I actually have a restriction here, what does that look like? So you do always need to localize and make sure that you're not creating these problems for yourself. Even if the overall exposure might be small, when you're cracking up $1 million a year in Zambia for a business that mightn't even earn that much, you don't want to be telling your CFO or your CEO that you got caught out by that trap. And I think they're the important things for people who are doing business across Africa to keep in mind. Obviously, if anybody, Eswatini is another country, not too many things happening there, but a couple of big players in the business in operating there. They've also taken on new legislation as well. So, I mean, we're having quite a lot of fun across Africa, that's for sure. You can go to the next slide, Paul. And I'm going to hand it over to Raj. He's going to talk about the misconceptions versus realities.
Thank you, Cabrini. So, misconceptions and reality. Often we see in Africa, there are quite a number of misconceptions about transfer pricing. One of them, the key is transfer pricing audits are rare in Africa. Well, over the past decade, transfer pricing has moved from being a relatively tax technical compliance issue in Africa to a central pillar of revenue mobilization for tax authorities. As Cabrini mentioned, most African jurisdictions have now implemented comprehensive transfer pricing regime aligned broadly with OECD TP guidelines and particularly following the BEPS project, or the famously known as Base Erosion and Profit Shifting project. So what do we see? As a result, we are seeing three major developments across the continent. First, increased audit activities. Tax authorities across Africa are significantly increasing transfer pricing audit activities as government seeks to protect their tax base. TP adjustments are increasingly viewed as a key resource of revenue, especially in sectors such as mining, telecoms, technology, and financial services. Second, stronger documentation framework. Many countries have implemented BEPS Section 13 documentation requirement, particularly local file, master file, or CBCR country-by-country reporting. What does this mean for multinationals? Multinational groups must now maintain far more detailed documentation to support intercompany transactions. And third, greater institutional capacity. Organizations such as ATAF, or commonly known as African Tax Administration Forum, have significantly strengthened technical capacity among African tax administration. That leads to more sophisticated audits and disputes. So overall, Africa is transitioning from a developing transfer pricing environment to a much more assertive enforcement landscape. So the next question I often hear is that how aggressive are transfer pricing audits becoming in Africa? The answer is simple. Transfer pricing audits are becoming significantly more targeted and technical. In many jurisdictions, audits now involve specialist transfer pricing units within tax authorities. These teams often receive trainings through international initiatives led by OECD and even in ATAF. Another notable development is the longer audit timelines Cabrini mentioned earlier, and the increasing use of retroactive adjustment, sometimes covering several years of historical transactions. Furthermore, many tax authorities now request transfer pricing documentation within very short timeframes, sometimes as little as few weeks after request. For multinational groups, this means transfer pricing documentation must be prepared contemporaneously and maintained locally, rather than compiled reactively during an audit. One of the key questions which comes to my mind and which begs answer is, what are the key transfer pricing risks for multinationals operating in Africa today? There are several areas where multinational enterprises are facing scrutiny, increased scrutiny. They are commodity pricing and extractive sectors. African tax authorities are placing significant focus on pricing of minerals and commodities. Mining jurisdictions such as Zambia, Democratic Republic of Congo, and Tanzania are increasingly examining whether commodity transactions reflect arm's length pricing. Second, and very commonly seen, is intergroup services and management fees. Tax authorities often challenge management and technical service fees, particularly where they believe the service do not provide clear economic benefit to the local subsidiary. Limited risk models. Many African subsidiaries operate in limited risk distributor or limited risk service provider model. Tax authorities sometimes challenge whether these entities are appropriately remunerated relative to the functions performed. What does it mean? Are they really limited risk, or are they performing a little bit more, or they're bearing more risk? And are they being actually compensated based on the risk taken? These are the common things which we see in day to day. Last but not the least is the financing arrangement. Intercompany loans and cash pooling structures are increasingly reviewed, especially where thin capitalization rules or interest deductibility limitations applies. Now, these risks are compounded by limited comparable data in many African markets, which makes benchmarking more complex, often leads to disputes between taxpayers and tax authorities. Well, if you see the other misconceptions which we have talked about here is the global transfer pricing documentation is sufficient. Well, many jurisdictions in Africa requires local TP documentation. They want to see whether local file has detailed analysis of the local entity's function, assets employed, and the risk assumed, and they want to see the local financial result, how much the local entity is earning, and if it is earning an arm's length. Commodity pricing is straightforward. You'll be amazed how several African countries have introduced specific pricing rules on referencing pricing mechanism on commodities. Why they do? To prevent profit shifting in natural resources sector, one of the key sector in Africa. And the most common is, well, large MNCs are affected, not mid-sized companies like us. They will not have time to look at. Well, to be honest, transfer pricing rule applies across all multinational groups engaging in cross-border RPTs. But very recently, and from last few years, we are seeing mid-sized companies are often being targeted and checked, whether they're limited risk models or the management service fee, whether there's a service benefit analysis being done, whether they have really received a benefit, and whether there is an economic value being transferred. They are being challenged on these kind of models, which we see often. So the misconception versus reality, if we are operating in Africa, you need to really think about it and not worry. Hand it back to you, Kabrini. Paul, next slide, please.
Sure, we can
Oh,
go to the next
before we
slide.
move on, I just have a question, Raji. You mentioned about the challenges around comparables and finding appropriate and comparables. How, in brief, how do you actually approach that? How do you get beyond limitations in terms of availability of data?
So what we do, we try to see if there are enough African companies there. There are many, like for example, I can quote, like we were looking for a resale price minus for a distributor recently, and we were not getting exact comparables. The tax authority, we were amazed at how the sophistication has reached. They went into the very details of raw data. They went through the gross margin, resale price gross margin. What is the cost of goods sold increase? Does it include just the cost of goods sold? Are they also including marketing expenses, depreciation? And those details, when we go to the famous databases, not all the comparables have those data. It is a huge risk, and huge channel. And we went through various, whether including material cost in place of cost of goods sold, or whether other things are there. And the sophistication, when we kind of got comparables close and tax authorities agreed, but they said, oh no, this doesn't fall in the value chain. The value chain, in different value chains they are looking for. So the sophistication of comparability is increasing. They are being trained by ATAF, as I mentioned. It's amazing to see the kind of information they have, the way they are trained, and the way they are approaching audit is more technical. So taxpayer their documentation needs to be robust, the benchmarking no more in the old ways of just doing a generic benchmark and just maybe float through. If there are questions, there is a problem. Yes, Cabrini?
Just the way in kind of to simplify it, how do we get around it is there's no such thing as African comparables. So your search strategy starts with, we looked at Africa, we got none. You actually have to show that step. Then we looked region. What they use is they use global studies, right? The African authorities want global studies. They don't accept European studies unless the tested party is over there. So the starting point is, and it's useful to note because obviously in the US they have a different approach to benchmarking. In Europe they have a different. In Africa you need a global. They use the Bureau van Dijk Orbis database, so they've got specific stuff that they do, and how you get around it is by showing you've done everything that you can do to get the best data. So it's quite heavy. They don't really deal with generic or group benchmarking studies. They won't look at them if it's not on the right database or if it's not in the right jurisdictions. So it just means there's quite a bit of extra work to do on that leg.
Thank you.
You can jump to the next slide. So here's 1,000 million court cases. So as a lawyer and as somebody who got into transfer pricing to get into the dispute resolution side, it's been quite exciting to see we actually have case law and we're getting more and more of it. South Africa had their first real, we say real because there's a few other kind of judgments case last year or 18 months ago or so forth. We had the ABD case and we had the coronation case. And then we got a load of actual cases popping up in Kenya, Nigeria, and surprisingly Mauritius, even before they had specific legislation, have advanced case law. So what is that? It's great for the taxpayer because it sets precedent. We have stuff in law to say, no, tax authorities, you can't do that. Let's refer to this case. But I want to talk about what these cases are covering, right? And it is a wide range of stuff. The ABD case, for example, was a South African multinational in the telecom space who essentially had subsidiaries all over the world, and they were charging a royalty of 1%, okay? So basically, SAR says, that's too low. We want more royalties and so forth. And of course, there was years of a case back and forth. This was a huge group and set a precedent around, first of all, what is IP, right? Because there was months of debate around that. Is it brand? Is it trademark? Is it know-how? Is it operational, right? So defining the IP went through a real rigorous debate. And then what method to use, and debates around that. And there was experts taken in from all over the place to kind of look at that. The outcome was actually that the taxpayer was successful. They had a cup to support it, and the royalty of 1% was fine. What does that mean for African multinationals is if we can only get paid 1% for IP, how is it that globally in Africa we're paying 3, 4, and 5% in royalties for similar stuff? So the next thing that we expect to see is SARS to challenge the outbound payments. In this case, they were looking for the money to them. Now they're flipping the script and saying, look at all these African or South African businesses. What did they pay a royalty for? Do they have this level of support? So there's a lot of scrutiny and a number of cases around intellectual property in Africa. So it's quite fun and plenty to read about in there. There's loads of other cases. Some will be familiar, like Nestle in Zambia, where it's a challenge about, am I a limited risk distributor or am I a distributor? So all about the functional characterization and as a result, how much money I'm entitled to. Massive thing that has been looked at is loss-making entities. If you're part of a multinational group and you're continuously making loss and you are paying anything to anybody else, the tax authority will love to look at you. And they'll say, explain your losses, why are you still there, what are you up to, and who are you paying this money to? The other thing that I just wanted to mention was financial transactions and loans. So we used to think, well, it's an interest-free loan. The local tax authority doesn't care, right? Because I'm not paying interest. So, what's their problem? Surely that's fine. What the clever, I'm not sure if it's the right word, what the clever tax authorities have done is they've started to deem interest. Why are they doing that? They say you should pay an arm's length interest because they're getting the withholding tax. So they will deem an interest and get the withholding tax on that. So they whether it's charged or not, they're deeming it. The other thing I wanted to say about how adjustments, how like exposures are calculated in these cases. You have your actual transfer pricing adjustment, right? But then you have what's called in some jurisdictions a secondary adjustment. So therefore they deem it as a dividend and you're paying up to 20% deemed dividend withholding tax on that. And on top of that, they have another layer of what they call interest. So often these cases are 10 years old. We just closed a matter which only covered up to the 2007, right? So interest kind of accruing can be massive. And then there's the penalties on top of that, which tend to be 100 to 200% on top of that. So your number from one small exposure in 1 year that you didn't handle over a 10-year period, when you add on all of those items, suddenly becomes something that your business cares about and the tax authorities are looking at. In these cases, again, there's too many to go through and they're all very exciting, but they look at intellectual property, they look at distribution, they look at commodity pricing, and And the key things that are scrutinized is like any place else in the world, your functional analysis and your substance. Does your legal agreements, and this is where you come in, Paul, because people have been so often caught out on what's in their legal agreements versus what's in their local file versus what happens on the ground. So the first thing a tax authority will look to do and say, your legal agreement says something totally different than what your local file says. And they'll use that the way they want. If they like what it says in your legal agreement, of course, the legal agreement is golden. If they like what it says in another place, so it's absolutely critical. And in many jurisdictions, you actually have to submit the legal agreements with your local file, right?
Mm-hmm.
You don't just submit the local file. You have to, in South Africa is a good example, submit the legal agreements. And obviously that's because they're going to scrutinize if your legal agreements is aligned with the functional profile and what's happening on the ground. The other thing that has popped up in lots of cases, nearly every case, is what is the proper method to support this transaction? And we know a different method can deliver a totally different financial outcome. If you use one method, you might be able to show you've no exposure, but if you use an alternative method, you might be sitting on a massive exposure. And there's been kind of a trend that people don't even know what method they're using. It's whatever somebody told them, their advisor told them once years ago, or whatever was settled on. But that has turned many cases on its head, saying, no, this method's no good. And then you're dealing with a total different level of exposure. So real scrutiny has gone into that. The other one is benchmarking studies. So the tax authorities doing their own benchmarking studies, which is never fun. Ripping other people's benchmarking studies apart, also no fun. But in some cases, coming up with their own comparables. So they obviously, tax authorities have a lot of oversight. So if there's a case where comparables can't easily be identified by the database, they will kind of scrutinize and come up with some of their own based on industry practice. So tax authorities will use their knowledge of one audit to tackle another audit. And I think I mentioned it earlier, but in case I didn't, because it's important, if you have a load of subsidiaries in Africa, I'm not sure who our audience is, but if you have more than one, and you've got a multinational leg, so external to Africa, one tax authority will talk to the other tax authority. So whether or not they're supposed to is another question. But you will see, and it's happened many, many times, there will be an audit of the model. They will put all their resources into one jurisdiction. We'll do Zambia now. And then based on that, they will roll that out into the other 10 or 2 or 3 African jurisdictions that you have. So oftentimes when we're thinking, what's our exposure? If we have that same model operating in multiple jurisdictions, our exposure needs to be looked at holistically. So that's caught out a few people. So obviously the tax authorities will take their learnings, invest in one place, and then go after, I don't want to say go after the industry, but roll out those resources in terms of that, which has, it's worked relatively successfully, I think, for them so far. You can maybe jump to the next.
But before we jump on, I'm just really interested to see Mauritius on the list, because it's something we've noticed. As you mentioned before, a lot of corporates actually creating substance there. So, what was the headline in terms of that case?
There was 2 cases. One was around loans. So Mauritius is absolutely, half of what it does, I would nearly say, is financial flows, and they have no interest being charged there. And also they have domestic transfer pricing in Mauritius. So there's lots of kind of multiple structures happening that people have not been looking at, but they've been basically deeming interest where there's no interest. So interest-free loans they've tackled. The other case was more around intellectual property and was around the residual profit split method and the amount of money that it was an interesting one, because it was that Mauritius wasn't making enough money. Obviously, that's what the MRA care about, but typically in Mauritius, that's not the problem. Typically, they're making, more money perhaps than would be. So it's always interesting, because obviously you have these jurisdictions that want to be super investor friendly, and that people go to those jurisdictions because they have an attractive tax system, but you take in a set of rules such as transfer pricing, which means you look at both sides. So what used to not be a risk for you, you always said, it's a Mauritian issue, we don't care about that, has become a risk because now you have a tax authority who has a mandate to make money. So they're going to start scrutinizing it. And those two cases both happened and were judged on prior to the issue of the legislation in the 2025 Finance Act, which says you have to maintain local file and master file. So that's why we're saying it doesn't matter if you have a local file or master file per the law, you have to comply with the arm's length principle per the law. It's under anti-avoidance provisions originally in the Mauritian law, but that's what they will use to do it.
Cool. And I can see we've got a question about the fast, I can't pronounce it, versus SARS case. Can you just say a bit about that one, please?
That one, we might have to come back to that one. The fast one, I can't remember it offhand. So you've caught me out on that. So I'll look at it and I'll send you an email. Who do I have here? To Benny. I'll send an email out about that one. Let me see me notes. Well, one of the things around all of these, right, the biggest factor that came out was lack of documentation and lack of evidence, right? So in all of these cases, it'll be like you had a local file or you didn't have the local file, but you haven't been able to discharge the burden of proof, right? So the burden of proof is generally on the taxpayer, and the level of evidence that they require to discharge that, it's obviously not just discharged by the local file, right? It is 10 years of retained evidence to show contracts, to show sales, to show substance, to show headcount, all of those things. And one of the issues that I think has come up in every one of these cases is around the burden of evidence and shifting that. And even in a recent case that was in Zambia, I believe, it came out again, and in some of the lower judgments, they had said that actually the tax authority has to discharge this burden of proof. And in the Supreme Court, it went back and said, no, it's the taxpayer that has the onus when it comes to transfer pricing in most cases. So quite a heavy load of documentation that supports all of these kind of issues.
And you mentioned before about choice of method, and you mentioned profit splits. Are you seeing a lot of cases where tax authorities in Africa are asserting that there should have been a profit split or that is an appropriate method as opposed to some other basis?
That was used in one case. It didn't work, and everybody said the profit split wasn't the right one. But generally, the tax authorities are not so au fait with that method. There's a number of major multinationals using that method in Africa, but they haven't. One case that I can think of where they specifically requested it. But I mean, basically, the method that they will be looking for is the method that, based on their analysis of the facts, will support the highest level of adjustment. So if they think it's the Tina Mem or they think it's this, that, or the other, they will look at it. And that's why there's so much debate about the method. And, you know, even long-standing technical experts on transfer pricing will debate what's the right method in some cases. But I mean, you don't know until you have the facts in front of you. It's not something they've called upon apart from in one case, and it's something that they're a little bit afraid of in other cases, because normally the profit split is applied to leave a routine margin in the African context. So normally it's applied like that. But yeah, we'll have to watch that space as that pops up more and more.
Cool, thank you.
So what are the practical steps to protect positions? Now, we've been saying this till the cows come home, but if you don't have your documentation, you don't have a defense, you will have all sorts of problems. Your documentation is absolutely critical. And there has been a trend globally, and the Big Four have different ideas on it, but to do quite light touch documentation. In Africa, if you do a light touch documentation, you will get hit with a litany of information requests that's 9 pages long. Where's this, where's that, where's the other? What they do to basically bypass you from the audit is they check at least you have all the stuff you're supposed to have, right? And if you don't, that's where they will move you to step 2 in terms of let's look at you a bit further. So best defenses in terms of that, it has come up in every single of those cases. the robustness of the documentation, and and it also leads, it makes an impact on your penalties. Let's say you find out years later that you have an exposure and you have to make a settlement. If you don't have documentation in place, you sit in you can argue interest and penalties significantly less. Because if you have independent documentation, you could say, we invested in it, we got the advice, we had it, we didn't do anything wrong on purpose, that type of thing. So documentation is key. Functional analysis obviously is key, because they're scrutinizing that and they want it per transaction, and they're cross-examining it if you have an audit in Africa, you'll be subject, and your team will be subject to interviews with the tax authorities, right? When they've decided you're worth taking a look at, it might start with a casual business discussion, or your individual person, and then they will kind of start to ask questions. So there'll be an interview process and an information request process that is extremely time consuming, in fact, because they want senior leaders in your business to tell who does what. They want department heads, it's quite rigorous. And they're basically going to make sure that what you say in your local file is correct, that how your business operates. So there's a lot of focus on that. And I think people in business need to know what your transfer pricing policy is, because all of a sudden they'll be interviewed and might be saying exactly the wrong thing. We need to keep an eye on the regulatory situation. We don't have these same issues in the rest of the world. In some cases we do, but like the caps on payments outbound, and are we characterizing the transaction in the right way? Sometimes or not. So keeping an eye on that and making sure that we're aware of that. Transfer pricing is annual. You need to keep an eye on it and make sure that you update it, and make sure you don't get hit with kind of silly penalties. And the first thing really always is to say, do we know what we're supposed to do in these jurisdictions? We always say, do a high-level health check of what's happening. Do we at least know the compliance requirements? Do we know where we need a local file? Do we know what the penalty is in that country? And then you can look at bigger questions like, is my model sustainable? Do I have the right components in place? But that's what it's about, is kind of knowing what you need to know, and when a matter, assuming you're compliant, when a matter is being raised, it comes in a simple request that may seem innocuous. It'll be like, can you please send us this, that, and the other, right? Data, information. Sometimes if people locally will actually provide information that actually can be really problematic later. So any bit of data that we provide needs to be kind of scrutinized in terms of, why does the tax authority want this, and thought through, because what they will ask is endless, and we do have a tendency to give what we're asked, right, to try and keep everybody happy. So I'd say we need to be extremely cautious in terms of that. Raj, did you have anything to add to that?
Yes, Cabrini. So beside data, we have to be very careful in terms of Incoterms, which we talk about. Often in the risk model, one thing you point about is your intercompany agreement. Second thing is the risk model. If you're saying you're an LRD or limited risk model, if you're a limited risk distributor, your Incoterms are talking actually in a different language. Incoterm says you're an FOB or CIF. That means you're taking more risk. You are actually you're having more assets in terms of inventory. So these things are also, so when Cabrini said you give data, you give all this data, and the data says you are a FOB or CIF, that means you are actually bearing more logistics risk, you are taking more inventory, but you said you are a limited risk, and that leads to adjustment. So we have to be very careful in what we are sharing. But initially, when we are doing the TP documentation, also, are we looking at, are they talking to each other? Are the Incoterms talking to your model? Are the intercompany agreement and the assets and the risk and the functions are talking to each other in terms of local files? So we have to look all those things very carefully.
And maybe just to add to that, and then Paul, we'll see what questions you have. The biggest issue often, and how an audit will start, is that the information is not mapped. Your local file says one thing, your legal agreement says another thing, and your set of financials say another thing, and your tax return might even say another thing. So you have a number of declarations about transfer pricing that you have to put into your tax return. But often the person who's doing that tax return doesn't know about all the other stuff that somebody's doing on transfer pricing. So you might, in some cases, there's even a click down button and people have answered it wrong and don't realize they're supposed to submit a local file, submit a master file, and have all of this stuff. Like this has happened quite a lot. And obviously your related party disclosures, right? What does your financial say? We tend to have poor related party disclosures sometimes, or, not mapping, but that is often getting people into kind of an easy area of an audit where stuff doesn't match. So the tax authority has questions. And once they start poking and prodding, if they feel there's somewhere to go, an audit can be a 3-year full team difficult exercise. But I would say the key takeaway from our side, and Paul, I'll leave the last word to you, is it's good to know the nuances in Africa. The tax authorities there are super excited because they think there's lots of money to be made about transfer pricing, and they are getting the people and the framework in place to get that sorted out. So at least we need to be aware of what are our compliance requirements and how best to manage them in a cost efficient and risk management sort of way.
And before we give to Paul, a couple of points I wanted to add was that there's several developments are likely to shape future of transfer pricing environment in Africa. First, the BEPS 2.0 framework is already influencing tax policy. From a Pillar 2 perspective, the introduction of 15% global minimum tax is prompting many African countries to reconsider tax incentive regimes. From a transfer pricing perspective, a particular important development is Amount B, which introduces a simplified method for pricing routine distribution activities. So we need to look at second, mining and commodity pricing frameworks will continue to evolve as government seeks a fair share of natural resource revenues. And third, the interaction between transfer pricing and global minimum tax rule will become increasingly important. And finally, we expect a continued increase in transfer pricing disputes and litigation as African tax authorities become more confident in enforcing their rules. So for multinational groups, Africa is becoming strategically important and increasingly sophisticated transfer pricing environment.
Fantastic. Well, thank you so much. We are at time, unfortunately. I guess from my perspective, what I've taken from this is, yes, it is absolutely a very different environment with its own specific requirements, its own peculiarities. The other thing which was very striking for me is the interaction between the different issues. So you have regulatory caps on management fees, royalties, and this interaction between TP adjustments, deemed dividends or whatever, withholding tax or deemed interest, and withholding tax on that, plus the penalties and interest. And so from my perspective, the most rational key takeaway is what you guys are mentioning, which is do a high-level health check or high-level assessment of where are you right now in the different countries where you're present in terms of status of compliance, and assessing that in the context of the risks, having in mind the penalties that apply, this compounding effect. And those two things together will basically drive the appropriate course of action to manage those risks and to take proportionate action.
Absolutely. And if anybody has any queries, you can drop it to Paul or us. We're obviously going to be sharing the slides, but I think that's it, Paul. Sometimes people think that the values of the transactions might be low. It's immaterial in the context of the group, but the headaches is what you want to avoid. So you need to know what you don't know and ensure you do what you need to do.
Absolutely. Thank you so much, Cabrini. Thank you, Raj. Thank you, everyone, for listening and watching. And we will share the slides and look forward to hearing any questions, comments. Thank you.
Thank you, Paul. Thank you, Raj.
Thank you, everyone.